It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to another episode on our weekend that is rolled into town. Yes, 7 days a week. Plenty of property information is heard on iHeartRadio, of course. You can also catch us on Spotify, Apple Podcasts and Amazon. Yeah, the weekend, Saturday, November the 23rd. Now, here's a thing that you really want to be paying attention to, because investors are being cautioned against chasing apparent bargains in a market where many investor-grade units are losing value. CoreLogic data is telling us that 65 unit markets in Sydney and Melbourne remain below their pre-COVID peaks. Now, this price will shock you. Some of these prices are down by as much as 18.4%. CoreLogic's Eliza Owen advises you to focus on building quality, property age and location. And while mid-20th century units often offer better quality, modern oversupply has subdued parts of the market. Let's catch up right now with Anthony Landau, the Managing Director and Mortgage Broker at Equilibria Finance. And good morning to you, Anthony. That is probably what I've just mentioned there with regard to those units, something that you're no doubt having those conversations with your clients.
Yeah, good morning, Craig. Great to be here. You made a little comment in there that is exactly spot on in relation to we're getting patches of markets where there is an oversupply, funnily enough, in some of those unit spaces, which is really impacting prices. And I think there was a comment in there by Eliza around finding that investor-grade property, and hunting for a bargain is often not the best long-term solution. It might provide a short-term entry into the market, but it may not be the best longer-term investment, stable capital growth. Hold your nerve as an investor. Keep looking for those good, strong investor-grade properties that deliver those longer-term returns.
Yeah, because with that piece of advice, it is going to continue when we get into 2025, the amount of people wanting to get into a unit. So it's very timely as we wind off the 2024 year. You were just telling me before you jumped on that it's one of the all-time busiest times of the year for you right now.
Yeah, spring's always very busy, but we seem to be having a busy flurry just before the year comes to a close and everyone winds up for a little bit of a break. There are some opportunities in the market. We're seeing some of the more affordable markets creating quite a lot of competition at the moment. There's more stock on the markets, both for first home buyers and investors. There's a bit of caution out there, but people are still out there wanting to try and secure a property before the end of the year. And we're seeing that come through in some of the activity that we're dealing with our clients.
Now, investors, they seem to be sending some mixed signals. On one hand, investor listings have surged to 13,000 in October. On the other hand, more investors are entering the market with 18,400 investor loans approved during the same period, and new investor loans rising by 18.8% over the 12 months to September. That is some new data from ABS. So what is going on right now with those investors, Anthony?
Yeah, it's a funny time to read what's happening with the investors. We had a very, very subdued investor market through COVID, through that period where interest rates were rising while investors were really just sitting out of the market, understanding their cash flow. And through that period as well, supply and demand there was a real mismatch. There wasn't a lot of investor grade properties, but we are seeing a bit of a mixed bag with investors at the moment. We're seeing listings up nationally about 18.8%, as you mentioned. We're also seeing loan commitments at a 5-year high. So we're seeing investors trying to exit the market. We're also seeing investors trying to enter the market. So there is a real mixed narrative. There's a lot of stuff about the regions, what's happening in different states, and there's also a change in demographic of what an investor looks like now.
And of course, the markets are running in different parts of Australia at different speeds. And I get the feeling that that's going to continue without a doubt into 2025. In fact, there might be a little bit of widening with the speeds of the market. I want to come back to the data. What is the data telling you right now?
You know, I like my data. So it very much is telling us it's a regional story. In terms of loan commitments, they've grown 18.8% nationally, but most of that uplift was driven by New South Wales, Queensland and Western Australia. Essentially, new investor loans is the demand side of the ledger. These are our higher capital growth areas. This is where the values have been holding up essentially, and investors are looking at capturing some of those high capital growth areas. The other side of the coin in terms of the lending side is in Victoria and Tasmania, where values have essentially been in decline. While some investors are looking for opportunities, we're also seeing investor loans commitments dropping down to a relatively low level of about 5.1%. But the trend in investor listings is also diverse. New investor listings in Victoria are about 3,800, which is about 30% of the national figure. So Victorian investors are selling up. Buyers aren't coming to the party at the moment. There might be opportunities to create value, but investors are very wary of that Victorian market with the new taxes coming in at the moment. Listings are below historic averages in South Australia, Queensland and Western Australia. So less listings, but what we're seeing is more demand in New South Wales, Queensland and Western Australia, where we're getting that capital growth.
All right, it is your Saturday real estate podcast, talking all things property investing and mortgages with Anthony Landau this morning. When we come back, we'll have a look at a couple of competing narratives and drill down a little bit about the national versus the regional. We'll do that next.
Unlock the secrets of real estate and stay informed about the latest real estate buzz with hot market trends, emerging suburbs, and hidden gems.
Why blow your advertising budget on ads people ignore? Connect your business to our niche real estate audience. It's a targeted way to reach the right people. We have over 1,000 episodes on real estate, the largest property podcast library in Australia. Our email address is myrealestatepodcast@gmail.com.
We are in the wine town, aren't we? Getting ever so closer to Christmas and the New Year break. It is a Real Estate Saturday with Anthony Landau here with me. And Anthony, let's look at those competing narratives. Firstly, what is driving investors from the market and what is bringing them into the market at the moment?
Yeah, well, the simple competing narratives are some investors are fleeing the property market, some investors are joining the property market. So work that one out. So coming to your question, essentially the reason there are investors exiting the market, they're struggling with the cash flow. They're turned off by the higher interest rates. There's some tenancy reforms in some states and there's increased property taxes in some states. While longer term, they might have been holding out to try and capture that capital growth, they're really struggling with their cash flow. We're seeing that with some of our clients who might have to sell an investment property because they can't hold the cash flow needs month to month, even if they're getting the gearing benefit, even if they're getting the capital growth benefit, particularly those investors maybe with 1, 2 or 3 investments plus an existing home loan, they're exiting the market. On the other hand, investor purchases are on the rise. Housing credit's risen strongly. The number of investor loan commitments are up year to year. What we're seeing there is there are some markets where investors are trying to capture the capital growth, but we're seeing a bit of a change in what that investor looks like. The investors coming into the market tend to be those that aren't quite as leveraged, so they're not, in a sense, stretching themselves as much. They might be a first-time investor that are looking at those more affordable regions as distinct from those more highly leveraged, highly indebted investors. The other thing is we're seeing a lot of first-time buyers looking at getting in the market and seeing an investment property as the opportunity as distinct from buying their first home. So, yeah, we are seeing those exiting for cash flow reasons, but we're also seeing a new range of investors coming into the market that might be buying their first property. that are looking for those capital growth areas. They may not be as leveraged, and there also are some first-time buyers starting out with an investment property.
All right, so some really key points that you've made there. I think what we should do is just look and kind of get those crystal glasses on once again. Are they looking rosy for investors into 2025? What do you think?
I think for investors, what we're going to continue to see is more investors entering the market. So I think that demand side will remain. I think that credit growth, those loan commitments will keep trending upwards. There's more property coming onto the market. There's more investor-grade properties coming onto the market. People are looking at potentially, we've reached a high on our interest rates. Investors have adjusted to the cash flow needs. Investors have adjusted to property values, which have all levelled out. So I think we're going to see the trend in demand increase. In terms of investors exiting the market, my sense is that will slow down. I think the Victorian sort of exit has happened or will come to a little bit of an end. I think generally speaking that those investors that have had those cash flow challenges have been dealing with that. We might get a little bit of an overflow into the new year, but I think with the view that interest rates will come down some stage next year, we won't see as many of those investor listings as we're seeing right now. And I think demand will keep on growing into 2025.
Well, I hope you are spot on. I hope you're right about that. I'd be feeling a whole lot better going into 2025 if we didn't have the potential of this trade war being unleashed around the world, but we will wait and see. Anthony, I reckon you should go out and have a bit of a surf today and just sort of relax as your weekend kicks in. Thanks for, once again, making some great points on the real estate breakfast this morning.
Great to be here, and that sounds like a pretty good idea with the week we've just had. So we'll catch up in a couple of weeks.
Each week, we bring you in-depth real estate discussions, including inspiring stories from homeowners, knowledgeable real estate professionals and economists. Whether you're a buyer, seller, or just a real estate enthusiast, we are your ultimate property podcast.
So you must have put in a pretty big effort here, for 2024, taking out top agent for most properties sold regional residential.
It was a bit of a surprise to me. Like the last few years, I feel like we've just been working, head down, bottom up. And like for the last 12 months, it has been harder. Like buyer sentiment has been like challenging and people are nervous to buy. But I think we offer really good value for money out here regionally. You can see that in the numbers of properties I've sold in the last 12 months.
This comes now off the back of you deciding to bite the bullet and go into business for yourself. Bit of a scary time for anybody opening up a business.
Correct, yeah. After 12 years at one of the national brands, Tasman and I, my business partner, went out on our own 4 months ago. Absolute perfect timing. The market still is extremely strong.
We connect you to the best real estate information across Australia. The Real Estate Podcast.